Options are tough. One person once described them as trying to play three-dimensional chess. There are a lot of things to think about. Most people, as I said, just think about buying low and selling high and think they can reduce it to one single dimension. However, there are a lot of things you have to consider before taking a position in an option. And the first is the price movement that you expect. You don't necessarily have to have a method that is going to predict exactly where the market is going, but it must be strong enough to give you a high probability outcome for a move of a certain percent. Obviously, if you have an approach that says it's time to buy but doesn't tell you whether the rally will be 2 points or 200, it's no good. But if on average your method is saying you can expect a 10% move out of this, at least a high percentage of the time, then at least you've got something that you can gain a perspective with. It'll allow you to trade the kind of option you need to trade. Your system then should imply a minimum size move. Okay, that's not enough. In fact, the next concern perhaps is the most important, and that is timing the entry. I'm not merely referring again to buying low or selling high. What I'm talking about is timing the entry relative to the action of the market at the moment. The most successful options traders buy calls when the market is collapsing, is already deeply in an oversold position, but at the moment is falling apart, ticks are minus 650 and everyone else is panicked. That is when people are throwing options overboard without regard to price, and if you're there with a little basket ready to catch them, you're getting them very cheap. Let's suppose the Dow Industrial Average is coming down very hard one afternoon, and just to pick a number, it's at about 2,000, but falling with ticks at minus 650. And an option is trading at 1.5 under extreme pressure. If the market makes a low a half an hour later and starts to rally, and by the time it's rallying, ticks are plus 400, and the market is back at exactly the same level, 2,000, that option could well be worth 2.5. And when you try to buy it, it'll be 5/8, 3/4, and ultimately you may end up paying almost 100% more for the option, even though the market was at the same level. So you have to time your entry to purchase calls into weakness or purchase puts into market strength. It's critical. Now, just as important is trying to anticipate the time length of the move. If you need the market to reach a certain level by the 3rd week of January and it doesn't do it until the 4th week, and you've got out of the money options or on the money options, they're going to go out worthless or you're going to lose money. So you have to have some kind of perspective on how long it will take the market to move, say, the 10% that your model suggests the market should move. If it's going to happen in 3 days, that means one thing. If it's going to take 6 months, that might mean purchasing an option a bit further out. Well, even that isn't quite enough. I think it's very important to have some idea of what the momentum of the move will be like. It's different if you're expecting the market to jump 50 points, let's say in a 3rd wave in an impulse, and perhaps struggle higher 50 points in a 4th wave of a C of a major bear market. Because momentum has a lot to do with the way people value options. If the market is soaring, say for the 3rd day, and opens higher and is moving, people factor that into their psychology. And they start projecting the present and the recent past into the future. And they say, man, if the market continues like this option is going to be worth 300 by a week from Tuesday. So naturally they're bidding it up and bidding it up. And it's going to be worth more than if the market moved to the same level but did it on very weak momentum, a lot of choppiness, moves back and forth, keeping people skeptical and so on, all the way up. It will be valued differently, the premium will be much smaller. This is more difficult to get a grasp of, but if you know some Elliott, sometimes you can get a handle on this as well. And that is, what kind of psychology will attend the move? A good example is in a wave 2 situation coming off of a high. If the market has come down in a first wave and is rallying in a second wave, people tend to be extremely bullish because the preceding move was a bull market move. And they look at wave 2 as a continuation of the bull market. The guy who was smart enough to buy calls at the bottom of wave 1, looking for a rally in wave 2, he's done his analysis, he counted 5 waves down, he said there's going to be a rally here and I can make money in some options. Even if the market rallies sharply, if he hasn't bet on the psychology, he may not have realized that those calls were already way overpriced because people were buying every pullback imaginable, and when the wave 2 gets underway, there just aren't any buyers left. And the few sellers that there are keeping the price from going much higher. It's amazing how many times you can buy a call even near a low and watch the market go up and the price of the option doesn't move because the psychology is not moving with it. It's already moved. So the best time to enter a position is when you feel that the psychology will change in the direction of your speculation. Well, that's 5 things to worry about. There's an overall answer to these 5 questions, and that is very simply, study your market. A lot of people think they can trade stock index options by studying the behavior of stock indexes. It sounds logical, but it really doesn't work. At the end of the year, they look at their balance sheet and find out they haven't made any money. And they may have called the market pretty well, or called the index pretty well. But what they failed to investigate was how options behave.